This show is part of OnePlace, a daily network of focused briefings across the stories people follow most.
Welcome to the program. We have a packed rundown today covering global energy shifts, technological breakthroughs, and the economic ripples affecting your wallet. Let's get right into the headlines you need to know.
US-Iran tensions send oil prices soaring once again.
China's robot marathon features record speeds and hilarious falls.
Peace talks stall as crude oil futures jump higher.
Global markets react to the renewed Strait of Hormuz blockade.
Ford's CEO explains his preference for Chinese electric vehicles.
UK recession fears grow as unemployment projections rise sharply.
Data centers offer a new path for laid-off workers.
European stocks tumble as Middle East peace hopes evaporate.
Starting with the energy crisis. The global energy market is reeling after the U.S. seizure of an Iranian-flagged cargo ship, the Tauska. This move has thrown the latest scheduled peace talks into total chaos, causing oil prices to jump significantly on Monday morning. Brent crude rose 5% to nearly $95 a barrel. This is a sharp reversal from Friday when prices had actually tumbled after Iran briefly declared the Strait of Hormuz open. The U.S. military intervention involved the USS Spruance, which reportedly disabled the vessel's engine room after it ignored warnings. This escalation is particularly worrying because the current ceasefire is set to expire this Wednesday. For households in the UK and beyond, this means the very real prospect of higher petrol costs at the pump and rising energy bills as we head later into the year.
It is an incredibly fragile situation, especially with the US and Iran supposed to meet in Pakistan for negotiations. President Trump has made it clear that if a deal isn't reached, the military is prepared to target Iran's power plants and bridges, using some very aggressive rhetoric. Meanwhile, Iranian state media is suggesting they might not even show up to the table now. Foreign Secretary Yvette Cooper is also weighing in, emphasizing that any final agreement must ensure the Strait of Hormuz remains a free navigation zone, without any tolls, which Iran has reportedly proposed. The international community is trying to build a consensus on this principle, but with the blockade still effectively in place, and the military action on the Tauska, the path to a peaceful reopening of this crucial shipping route looks more difficult than ever.
Now to some lighter news. China recently hosted a humanoid robot half-marathon in Beijing that was equal parts impressive and chaotic. A robot from the tech company Honor actually managed to clock a time of 50 minutes and 26 seconds. To put that in perspective, the current human world record for a half-marathon is over 57 minutes. This shows a massive leap in technology compared to last year's event, where the winner took over 2.5 hours. However, the speed wasn't the only thing people were talking about. Social media has been flooded with clips of the less successful participants. One robot famously face-planted right at the starting line, breaking into several pieces. The sight of staff members rushing out with a medical stretcher to carry off the robotic limbs has become a viral sensation, providing a bit of comedy alongside the technical achievement.
The videos are truly something else. You see robots veering into barricades and engineers frantically chasing after them with remote controls to keep them on track. It really highlights the gap between peak performance and the everyday reliability of these machines. Elon Musk has noted that Chinese companies are likely to be the biggest competitors to Tesla's Optimus robot, and this event proves they are moving fast. Even with the mishaps, like the Xpeng robot that flopped during a showcase earlier this year, the progress is undeniable. The number of teams participating jumped from 20 to over 100 this year. While it looks like a comedy of errors when they fall, the fact that a robot can now technically outrun the fastest human over 13 miles is a milestone that shouldn't be overlooked, despite the scattered parts on the track.
Back to the oil markets. The volatility in the oil market reached a fever pitch Sunday night as peace talks between the U.S. and Iran appeared to collapse before they even started. When the markets opened in New York, Brent crude futures surged by 7%, hitting $97 a barrel. This spike is a direct reaction to the uncertainty surrounding the Strait of Hormuz, which handles about 20% of the world's oil and liquefied natural gas. We are seeing the real-world consequences of this already. In the U.S., the national average for a gallon of gas has surpassed $4 for the first time in nearly 2 years. Other countries are taking even more drastic measures, like the Philippines implementing a 4-day workweek for government employees to save on energy. The brief period of optimism we saw last week has been completely erased by this new round of tension.
The rhetoric coming from the White House is certainly not cooling things down. President Trump posted that while his representatives are heading to Pakistan, he is prepared to knock out every single power plant in Iran if they don't accept what he calls a fair deal. Iran responded almost immediately, stating they would not participate in the second round of talks because of what they described as Washington's excessive demands. This stalemate is what's driving the overnight trading prices so high. Airlines are already feeling the pinch with rising jet fuel costs, leading to canceled routes and higher fees for travelers. It is a classic supply-side shock where the mere threat of a prolonged closure of a major shipping artery is enough to send the global economy into a tailspin. And right now, neither side seems willing to blink first.
Checking the global stocks. Despite the surge in oil prices, Asian stock markets actually showed some resilience on Monday. Indices in Tokyo, Seoul, and Hong Kong all posted gains, even as U.S. benchmark crude climbed over 5% to $87 a barrel. This creates a strange divergence in the markets. On one hand, you have the very real threat of an energy crisis. But on the other, some investors seem to be betting on momentum. Analysts are warning that this might be a case of overpricing, hope rather than a reflection of solid economic conviction. Just last Friday, U.S. stocks hit record highs when it briefly looked like the Strait of Hormuz would reopen. That optimism was short-lived, as Iran reversed its decision, and the U.S. Navy blockade remained in effect. The market is currently caught in a tug-of-war between record-breaking rallies and the harsh reality of a potential war.
It is fascinating to see how the S&P 500 and the Dow have jumped more than 12% since late March, largely on the hope that a worst-case scenario can be avoided. However, the cost of that hope is becoming very expensive. If the flow of oil doesn't stabilize soon, the pressure on gasoline prices will eventually bleed into everything else, from credit card interest to mortgage bills. The current standoff is preventing tankers from moving vast amounts of crude, and while Asian shares advanced today, the sustainability of that growth is in question. If the strait remains closed, the relief that investors were expecting for consumer products and shipping costs simply won't materialize. We are seeing a market that is desperate for good news, but the geopolitical reality on the ground in the Persian Gulf is providing the exact opposite right now.
Shifting to the auto industry. Ford CEO Jim Farley has made some waves by admitting he has been driving a Chinese-made Xiaomi SU7 electric vehicle for the past 6 months, and he absolutely loves it. In a recent interview, Farley explained that his decision to test the Xiaomi over a Tesla was intentional. He argued that while Tesla has been successful, they don't currently offer what he considers an updated vehicle that can compete with the rapid innovation coming out of China. Farley specifically pointed to companies like BYD as being the best in the business right now, citing their superior supply chains and manufacturing expertise. He believes that for Ford to survive the next cycle of the EV market, they need to match the cost competitiveness of these Chinese platforms, especially as American customers look for affordable electric pickups and utilities in the $30,000 price range.
Farley's comments are a stark warning for the U.S. auto industry. He has described the potential entry of Chinese cars into the American market as devastating to domestic manufacturing. This is why Ford is pivoting its strategy, moving away from high-end electric trucks like the F-150 Lightning and focusing more on smaller, affordable hybrids. The price gap is a major factor here. Tesla's cheapest model starts around $37,000, while Ford is aiming for that $28,000 sweet spot with vehicles like the Maverick Hybrid. By driving the Xiaomi SU7, Farley is getting a first-hand look at the competition that he says he does not want to give up. It is a rare moment of transparency from a major American CEO, acknowledging that the heart and soul of U.S. manufacturing is facing a massive technological and price point challenge from overseas.
Now for the UK outlook. The economic forecast for the UK has taken a grim turn, with reports suggesting that 250,000 people could lose their jobs by mid-2027. The country is currently flirting with a recession as business confidence is shattered by the ongoing conflict in the Middle East. Chancellor Rachel Reeves has even summoned bank chiefs to discuss how to contain the fallout. The EY Item Club has warned that the closure of the Strait of Hormuz and the resulting spike in energy prices could cause the biggest economic hit since the pandemic. They expect the UK economy to flatline for the next 2 quarters, which would meet the technical definition of a recession. Growth projections for this year have already been halved, dropping from 1.4% down to just 0.7% as the momentum from earlier in the year evaporates.
It is not just the growth numbers that are worrying. It is the impact on everyday people. Unemployment is projected to hit 5.8%, up from the current 5.2%. Finance chiefs at major UK firms are already pulling back on their spending and hiring plans, according to a separate report from Deloitte. This cautiousness is being driven by spiraling energy costs and supply chain disruptions that are squeezing consumer spending power. Inflation is also expected to remain sticky, potentially hitting 4% in late 2026, which is double the Bank of England's target. While policymakers might avoid immediate interest rate hikes, the overall sentiment among households is at a nearly 3-year low. People are running down their savings at the fastest pace in a year, just to keep up with the rising costs of living and debt.
Looking at tech career shifts. For the thousands of tech workers who have been laid off recently, there might be a massive opportunity in a place they haven't considered: data centers. Carrie Charles, the CEO of staffing firm Broadstaff, says that while the corporate job market is sluggish, the demand for data center technicians and skilled electricians is on fire. As big tech continues to build out AI infrastructure, the need for people to install and maintain the physical hardware is skyrocketing. Job listings in this sector increased by 64% between 2023 and 2025. Charles describes these roles as white-collar trade jobs. They offer a way for people to stay in the tech world and work with cutting-edge equipment without being stuck behind a desk all day. It is a hands-on career path that is currently facing a major talent shortage.
The disconnect is quite striking. You have all these people in their 30s and 40s struggling to find traditional office roles, while 54% of data center executives say their biggest hurdle is finding enough talent. Employment in U.S. data centers has already grown by 60% over the last several years, and that trend is only accelerating with the AI boom. These positions often come with high salaries because the work is so specialized. It involves everything from managing complex cooling systems to ensuring the massive servers that power our digital lives stay online. For someone willing to pivot mid-career, it offers a level of job security that the traditional software or middle management sectors currently lack. As more of these massive facilities pop up across the country, the demand for people who can actually touch the tech is only going to grow.
Finally, the European markets. European stock markets opened lower on Monday, as the optimism from last week completely vanished. In London, the FTSE 100 dropped by nearly 0.5%, moving away from the 6-week high it reached on Friday. Germany's DAX and Italy's FTSE MIB saw even steeper declines, falling over 1% each. The primary driver is what analysts are calling the Hormuz chaos. Investors who were looking on the bright side last week are now facing the reality that a clear way out of the energy crisis is impossible to foresee. Oil and gas prices have jumped another 5%, and this is weighing heavily on market sentiment. The confusion over whether the strait is open or closed has left traders on edge, and the expected lower opening for U.S. futures suggests this downward trend might continue throughout the global trading day.
The impact on consumer sentiment is also becoming very clear. In the UK, household confidence has dropped to a 33-month low. People are increasingly worried about the labor market and the potential for further spikes in their utility bills. This unease is showing up in consumer behavior, with many people cutting back on big-ticket items and taking on more debt to cover daily expenses. Economists are noting that the conflict in the Middle East is acting as a major drag on overall sentiment, making near-term inflation much stickier than central banks would like. As long as the energy market remains disrupted, the pressure on households and the volatility in the stock markets will likely persist. It is a difficult environment for investors and consumers alike, as the hope for a quick resolution to the regional conflict continues to fade.
That wraps up our briefing for today. Join us again tomorrow for more focused coverage of the stories that matter most to you. Have a great day.